Impairment of goodwill. Goodwill arising on business combination is not amortized, but it is tested for impairment annually. If goodwill is impaired, if goodwill was recognized under full goodwill method, that is, goodwill relates to both parent and NCA, then journal entry for impairment in consolidated financial statements as there is no goodwill in separate financial statements. Entry will be consolidated other equity account debit, parent share, NCA account debit, NCA share to goodwill account. Impairment of goodwill is to be borne in the ratio of goodwill and not in the ratio of percentage of holding. If goodwill was recognized under partial goodwill method, that is, goodwill relates to parent only, journal entry for impairment in consolidated financial statements as there is no goodwill in separate financial statements. Journal entry will be consolidated other equity account debit to goodwill account. As per ICAI, under full goodwill method, bifurcate the impairment in the ratio of stake. Next, step acquisition or multiple acquisition are acquisition achieved in stages or acquisition of interest in subsidiaries at different dates. If any subsidiary is acquired in lots through multiple acquisition, then consolidation begins from the date of obtaining control. That is, goodwill will be computed only on the date of control. Acquisition where control was obtained on later acquisition. First acquisition, for example, 10% has been acquired. Second acquisition, 60% has been acquired. Or first acquisition, 25% has been acquired. On second acquisition, 45% has been acquired. Control was obtained after second acquisition. Hence, all 6 steps of acquisition will be followed from the date when control is obtained. Goodwill will also be calculated only when control is obtained. Investment held before obtaining control will be revalued at its fair value in consolidated financial statements on date of acquisition of control. Journal entry to be passed in consolidated financial statement is investment account debit to P&L or OCI account. In SFS, the previously held investment may be valued at cost or fair value. On obtaining the control, we need not change that value in SFS. Next, further acquisition where control already existed in previous acquisition. First acquisition, 65% has been acquired. Second acquisition, another 10% has been acquired. In such a case, goodwill will not be recomputed or adjusted as goodwill is computed only on acquisition, date of acquisition of control. When parent acquires further investment, NCA share will be reduced. That is, NCA will be derecognized and reduction will be done on pro rata basis based on value of NCA as on date of derecognition of NCA. Journal entry in CFS will be non-controlling account debit, NCA account, non-controlling interest account debit, consolidated other equity account debit, that is the loss on acquisition. It will be the balancing figure to bank account to consolidated other equity. The difference will be transferred to consolidated other equity. If it is profit, it will be credited. If it is loss, it will be debited in CFS. Next, disposal of shares in subsidiary. Shares in subsidiary may be disposed either without loss of control or with loss of control. In case of without loss of control, stake before disposal is 80%, disposal 15%, then stake after disposal is 65%. NCA share will be increased by 15%. How 15%? 80% minus 65%. That is, we will recognize NCA. There are 2 methods to recognize NCA: fair value method, proportionate share of net assets method. Fair value method. Fair value of NCA as on date of disposal is directly given are identifiable net assets of the subsidiary, including goodwill, can be taken as fair value of the total subsidiary into percentage of NCA by which it is increased. In case of proportionate share of net assets method, identifiable net assets of the subsidiary into percentage of NCA by which it is increased will be considered. We will get total NCA. We need to calculate total NCA. How to calculate total NCA? Opening NCA before disposal plus NCA recognized on disposal. We will get a total NCA. Next, disposal of shares in subsidiaries with loss of control. For example, stake before disposal is 80% and disposal is 70%. Stake after disposal is 10%. As control is lost, parent entity will derecognize NCI and identifiable net assets of the subsidiary, goodwill or gain on bargain purchase. Recognize proceeds received, investments retained, if any, at fair value on date when control is lost. Reclassify to P&L or transfer directly to retained earnings if required by other Ind AS the amounts recognized in OCI in relation to the subsidiary. Balance, if any, will be transferred to P&L account. In case of a disposal of shares in subsidiary without loss of control, in SFS, the journal entry will be bank account debit to investment on pro rata basis. Balance difference will be transferred to P&L account. Debit, loss, credit, profit. In CFS, bank account debit to NCI account. Balancing figure difference will be transferred to other equity. Loss, debit, profit, credit. Disposal in shares of subsidiary with loss of control. In SFS, the entry will be bank account debit to investment pro rata. Difference will be transferred to P&L account. Loss will be debited. Profit will be credited. In CFS, entry will be bank account debit to NCI, bank account debit, NCI account debit, investment account debit, return portion, gain on bargain purchase account debit to identifiable net assets to goodwill account. Balance difference will be transferred to P&L account. Loss will be debited. Profit will be credited. Next, loss of control of a subsidiary in two or more arrangements, that is transactions. A parent might lose control of a subsidiary in two or more arrangements, that is transactions. However, sometimes circumstances indicate that multiple arrangements should be accounted for a single transaction. The above requirement is relevant because Ind AS 110 requires an entity to record gain or loss on disposal of investment in subsidiary in P&L only when control is lost. In determining whether to account for the arrangements as a single transaction, a parent should consider all the terms and conditions of the arrangements and their economic effects. One or more of the following indicate that the parent should account for the multiple arrangements or a single arrangement. They are entered into at the same time, are in contemplation of each other. They form a single transaction designed to achieve an overall commercial effect. The occurrence of one arrangement is dependent on the occurrence of at least one other arrangement. One arrangement considered in its own is not economically justified unless it is considered together with other arrangements. Example, when a disposal of shares is priced below market and is compensated for by a subsequent disposal priced above market. These are the indicators that the parent should account for multiple arrangements as a single transaction. So, any of these indicators exist, then it will be considered a single transaction. Subsidiaries cumulative preference shares classified as equity held by non-controlling interest. If a subsidiary has outstanding cumulative preference shares that are classified as equity and are held by non-controlling interest, the entity shall compute its share of profit or loss after adjusting for the dividend on such shares, whether or not such dividends have been declared. For example, R Limited hold 80% stake on Y Limited. Y Limited has also issued 10% cumulative preference shares worth 10 lakhs to the non-controlling interest. During the year, Y Limited earned profit of 5 lakhs. Y Limited has not declared any dividend on cumulative preference shares for the current year. In such case, the profit attributable to R Limited for current year would be total profit of Y Limited, that is 5 lakhs, less dividend on preference shares, that is 10 lakhs into 10%, that is 1 lakh. We will get the net profit 4 lakhs. Profit attributable to R Limited, that is 80% of 4 lakhs, 3 lakh 20,000. Elimination of intragroup transactions. Ind AS 110 states that intragroup balances and intragroup transactions should be eliminated in full in CFS. Example, liabilities due to one group entity by another will be set off against the corresponding asset in the other group entity's financial statements. Sales made by one group entity to another should be excluded from turnover and from purchase or related head are the appropriate expense head in the consolidated P&L. Resulting unrealized profits, if any, will also be eliminated. Uniform accounting policies. A parent shall prepare CFS using uniform accounting policies for like transactions and other events in similar circumstances. That is, accounting policies of subsidiary should be made uniform with parent for consolidation purpose. Example, A Limited, a company incorporated and registered in India, has a subsidiary B Incorporation, a company incorporated and registered in United States. A Limited follows Ind AS for the preparation of its financial statements. However, B Incorporation follows generally accepted accounting principles in US, that is US GAAP. Hence, while using B Incorporation's financial statements for the purpose of preparing consolidated financial statements of A Limited, appropriate adjustments should be made to B Incorporation's financial statements to convert its US GAAP financial statements to Ind AS financial statements. If nature of inventory of parent and subsidiary is different, then in CFS different cost formulas may be used for both the inventories. Depreciation method, useful life, residual value are not accounting policies. These are accounting estimates. Hence, parent and subsidiaries may have different depreciation method or useful life of assets. Can NCA be negative? The entity shall attribute total comprehensive income of a subsidiary, that is P&L and OCI, to the parent and the NCA even if this results in NCA having a deficient balance. Therefore, NCA can be negative when post-acquisition share of subsidiary losses are allocated to NCA. Therefore, NCA can be negative. Reporting date. The financial statements of parent and its subsidiaries used in preparation of CFS shall have the same reporting date. When the end of reporting period of a parent is different from subsidiary, the subsidiary for consolidation purpose prepares additional financial information as of the same date as the financial statements of the parent to enable the parent to consolidate the financial information of the subsidiary unless it is impracticable to do so. If it is impracticable to do so, the parent shall consolidate the financial information of the subsidiary using the most recent financial statements of the subsidiary adjusted for the effects of significant transactions or events that occur between the date of those financial statements and the date of consolidated financial statements. The difference between the date of subsidiaries financial statements and that of the CFS shall not be more than 3 months. Acquisition of interest, that is control in subsidiaries without consideration. An entity, say entity A, sometimes obtains control of another entity, say entity B, without transferring consideration. Such circumstances include that another entity, entity B, repurchases a sufficient number of its own shares from an existing investor. Minority veto interest, minority veto rights lapse that previously kept the investor, entity A, from controlling the another entity, entity B, in which the investor, entity A, held the majority voting rights. The investor, entity A, and the investee, entity B, agree to combine their business by contract alone. The investor, entity A, transfers no consideration in exchange for control of the investee, entity B, and holds no equity interest in the investee, either on the date of acquisition or previously. In a business combination achieved by contract alone, the investor, that is the parent, will recognize net assets of the investee in accordance with Ind AS 103 and prepare CFS. Investor will consolidate the financial statements with the investee even if the results in allocating all of the value to NCA, as the investor does not hold any equity interest. Chain holding under consolidation. What do you mean by chain holding? A parent company can establish control over subsidiaries directly or indirectly. Chain holding refers to situations wherein a parent is controlling a subsidiary indirectly, that is, having a control interest over a company indirectly. This may happen in number of ways. For example, parent company P Limited holding control interest in a subsidiary S1 Limited, and such S1 Limited in turn is holding a control interest in another company S2 Limited. In this case, P Limited is having an indirect control over S2 through its direct subsidiary S1. Example number 1. Parent P holds 80% in S1. S1 holds 80% in S2. In the above case, P holds a controlling interest in S1, which in turn holds a controlling interest in S2. S2 is therefore an indirect subsidiary of P. In other words, a subsidiary of P. Effective stake of P Limited in S2 is 80% of 80%, that is 64%. Example number 2. P Limited holds 75% in S1 Limited, and P Limited also holds 10% in S2 Limited. S1 Limited holds 60% in S2 Limited. Effective stake of P Limited is in S2 is 10% plus 60% of 75%. It will comes to 55%. Next, P Limited holds 80% in S1 Limited. S1 Limited holds 60% in S2 Limited. Effective stake of P Limited in S2 is 60% of 80%, that is 48%. Just because the stake is less than 50%, it does not mean that P Limited does not control S2 Limited. P can control S1 Limited 100% and S1 can control S2 Limited 100%. Hence, P can indirectly control S2 Limited. In Ind AS, stake is not important, but control is important for determining parent-subsidiary relationship. Date of effective control. The date the subsidiary S2 comes under the control of the holding company is either the date P Limited acquired S Limited, S1 Limited, if S1 already holds shares in S2, or if S1 Limited acquired share in S2 Limited after the acquisition of P Limited, then the date of control of P Limited in S2 Limited will be when S1 Limited acquired S2 Limited. Example first one, the date P Limited acquired S1 Limited if S1 already holds share in S2. P Limited acquired 100% in S1 as on 31st March 2017, and S1 S Limited has acquired 75% stake in S2 Limited as on 1st April 2016. In this case, consolidation of P Limited with S2 Limited will begin from 31st March 2017. Next, example of if S1 Limited acquired share in S2 Limited after the acquisition of P Limited, then the date of control of P Limited in S2 Limited will be when S1 Limited acquires S2 Limited. Example, P Limited acquired 100% in S1 Limited as on 31st March 2017, and S1 Limited acquired 75% stake in S2 Limited as on 1st October 2018. In this case, consolidation of P Limited with S2 Limited will begin from 1st October 2018. The date of acquisition or date of effective control is important because purchase consideration, identifiable net assets, non-controlling interest, goodwill or gain or bargain purchase are calculated as on date of acquisition or date of effective control only. Consolidated profit and loss. Parent should consolidate line by line items of profit and loss of subsidiary. Consolidated P&L should be prepared from date of acquisition of control. Hence, if the control is acquired during the year, then an entity includes the income and expense of a subsidiary in the consolidated financial statements from the date it gains control until the date when the entity ceases to control the subsidiary. Income and expense of the subsidiary are based on the amounts of the assets and liabilities recognized in the consolidated financial statements as on date of acquisition. Example, on the date of acquisition of control by A Limited over B Limited, the fair value of B Limited's property, plant and equipment were 100 lakhs, and such assets are recorded in the consolidated financial statements of A Limited. At that value, however, the carrying value of such assets in the books of B Limited as on the date of acquisition was 80 lakhs. Hence, for the purpose of consolidated financial statements, the depreciation expense should be computed based on 100 lakhs, not 80 lakhs. Next, journal entry for intercompany income and expense are sale or purchase. They should be eliminated. The journal entry will be sale or income account debit to purchase or expense account. The above elimination is to be done only when date of transaction is after date of acquisition. Next, Dividend income of the parent received from subsidiary will be settled off. Only parent share will be eliminated. Only parent share will be settled off. The journal entry will be consolidated P&L account debit to other equity. Consolidated P&L, dividend income of the parent, other equity means reducing dividend paid by subsidiary. Next, unrealized profit within the group will also be eliminated. Journal entry in case of upstream transaction, consolidated P&L account debit to inventory account, consolidated P&L reducing profit earned by subsidiary to inventory. Inventory of parent which is present in consolidated balance sheet. Journal entries in case of a downstream transaction, consolidated P&L account debit to inventory account, consolidated P&L reducing profit earned by the parent, inventory of the subsidiary which will be shown in consolidated balance sheet. The effect of consolidated P&L can be given either by creating a separate head or by adjusting closing stock, that is by eliminating the profit element. Additional depreciation are savings in depreciation due to revaluation on depreciable assets of the subsidiary and its related tax effects. The journal entry will be consolidated P&L account debit to PP, property, plant and equipment. Consolidated P&L on revaluation of subsidiaries assets. PP. PP is the subsidiary asset which will be shown in consolidated balance sheet. Impairment of goodwill. The journal entry in case of full goodwill, consolidated P&L account debit, parent share to NCA account debit, NCA share to goodwill. Journal entry in case of partial goodwill, consolidated P&L account debit to goodwill.